All right, so I want to put together a quick video on how not to get owned trading earnings using options. Um, Week in, week out, I see this guy's account tweeting just absolutely garbage statistics that are completely wrong about implied earnings moves. Uh, Guy ends up getting retweeted. Invariably, it ends up in my timeline somehow. And I see these numbers, and I'm just like, these things are so wrong, it makes my brain hurt. I can't believe this guy routinely posts this in week in, week out. But he does. And it gains traction. It gets all kinds of retweets and favorites and stuff. And for anybody trading off these numbers, they're probably going to get their asses handed to them because they're all wrong. Uh, so, and I'm just going to put this up as a brief explanation as to why they're all wrong. The Cliff's Notes version is these all assume, every single one of these numbers assumes that options expire immediately after the earnings announcement, which is not the case. So we can look at Salesforce CRM, 6.6%. It reports Monday after the close. So this guy's getting the implied move from the at the money straddle, which we can go to the SIBO website. You can look at the or any broker or whatever. I'll just use the CBOE. You can look at the at the money straddle price right here. You add up, go mid market for bid and ask on the put, mid market, bid and ask on the call, and it's going to get you to about $11.10 for the two, and that's about a 7% move or so. But that again assumes that options expire immediately after the earnings announcement. However, there's 4 days following the announcement. So using this handy little option calculator, any broker program platform is going to have like a simulation thing that you can do with options. I just use the calculator. I don't know why. I just like the calculator. It's just easier. I have my own that I use in an Excel spreadsheet, but whatever, using this thing. Again, just wanted to make a quick video here. But days to expiration, we get 4 days. So we can see from here, implied volatility is marked at, SIBO has it marked at 66%. But that's as of the close Friday, so that was 7 days ago. But you have to adjust this up. So we'll go with that, just so you can see where they get the numbers from. So the implied volatility is actually going to be around 73%. And that's going to get you, or 72% maybe, 5 days. This is into the announcement, so you're probably looking at 72%. So you're at about $11.10 combined, which is what the options were priced at on the close on Friday. Probably be about the same going into the announcement Monday afternoon. So they're going to be marked at about 72% with 5 days to expiration. Okay. And that's where this guy's getting the 6.6% on this move. Obviously, options are going to open Tuesday morning. And, okay, so let's enter. We change the days to expiration to 4. We'll change volatility to 0. And you can look right over here. The call's at 0, the put's at 0. That is not going to happen. I can guarantee you that is not going to happen. So there's, the implied vol will probably be slightly elevated. It's not going to be 72% unless something crazy happens. During the earnings announcement, it'll probably fall back toward the backdated implied vol. So you can see here the implied vol's somewhere around 35%. I'd be surprised, and that's for April. So May expiration's down to 30, June expiration's down to 30. So I just estimate that implied volatility will probably open around 40% on Tuesday morning. Yeah, we can calculate that. So you can add up these two numbers. We get 278 for the call, and this is assuming the stock doesn't move at all. 551 would be the total, adding up the call and the put together. Divided by 165. So you're looking at a remaining end of week move of 3.3%. So it's going to be, that's like the residual vol left after the announcement. So this guy's calling for an earnings move of 6.6%. The options market's actually baking in an earnings move of about 3.5%. So just about half what this guy's calling for is what the options market's, basically saying is likely to happen. Off a back of the envelope estimate of where vol might open on Tuesday morning. So if you're like, 6.6%, that seems expensive. It usually moves like 3%. I'm going to sell this. Well, the options are actually baking in a 3% move. So you're going to get your ass handed to you if you sell this thing and it moves 4%, So it's just bad math. It's just terrible. Or it's lazy. It's lazy math. And to put this out there and, have people out there putting trades off this is just negligent at best and a disservice to anybody that might be placing a trade off of it. The Kohl's numbers, 7.5%. You can do the same thing with Kohl's and go up here to the SIBO website, tap in Kohl's. We're going to look at the closed at 68. So you take mid-market of the put, mid-market of the call, add that together, and you're going to get this move, 7.5%. Again, Kohl's reports Tuesday before market open. So options, they don't expire, right before then. So we're looking at, 68 for the stock price, 68 for the strike. Days to expiration is going to be 4. Implied volatility. So going into the announcement, it's probably somewhere around like 90%, 256, 254. That gets us pretty close to what these options are. And you can see, implied vol is marked at 77%, but that was, based on Friday. There's going to be less days to expiration, so the only way to make up for that is to increase the implied volatility. Keep that premium about the same. But so that's going into the numbers. And then, of course, his estimate again for Kohl's, just like all the other ones, assumes that options expire immediately after the announcement or, implied volatility goes to 0. It's one or the other. Either options expire immediately after they announce or implied volatility goes to 0 after they announce, and there's still 4 days to expiration. Neither one of those is going to happen. So you're still going to have 4 days to expiration. Implied volatility, we'll go back to this quote table and we'll look out. So again, it's at 90%. You got to keep that in mind, adjust for the straddle, for the amount of time there is. Look out toward the back months, April. Let's see. Weeklies are looking like 40%, May 37, 35%, July. So I'm guessing implied vol will probably open around 45% here, maybe. It's just back of the envelope stuff. This is assuming, just assume the stock doesn't move. Strike is the same. 4 days to expiration. So basically, all else being equal, we're just going to change the implied volatility to where it crushes afterwards. And we get 129 and 127. Add that up, and gives us $2.56 for the remaining straddle. Divide that by 68, or divide into 68. That gives us plus minus 3.8% by the end of the week. So, which is, let's see, where does he have? 7.5. So that's about half the implied move for Kohl's. So again, if you're looking at this, you're like, wow, 7.5%. That's a big move for Kohl's. I don't think Kohl's is going to move 7.5%. I'm selling the straddle. But what you have to realize is that residual vol after the earnings news. You're probably looking at half that. So if you're selling that looking at 7.5%, you're wrong. And much like CRM, you're probably going to get your ass handed to you. Now, if you don't know any better, that's okay. This guy should know better than that, as he is purported to be an option millionaire. But again, I just wanted to make this video. This thing like drives me crazy, but it's not really my problem. I know better than that. But for other people who are starting out trading options, if you don't know that and you're looking at this and you take this at face value and you place an options trade off it, you're probably going to have some problems. But just a quick video, not really refined or anything, but I hope it helps somebody out there and prevents them from getting their ass handed to them. Take care.